We tend to overestimate the effect of technology in short run and underestimate the effect in the long run. Blockchain is hyped now, but potentially it's efficient and disruptive in the long run. Hello everyone, my topic for the session is Let's Blockchain and Do Banking. I'm Yatin Dhakad. I have completed my MSc in Information and Technology from Mumbai University and currently pursuing MBA from ICFI Business School, Mumbai. I'm interning in HDFC Bank, and my title of this internship is Blockchain Technology for Inventory and Auto Financing in Banking Sector. So, let's have a quick overview of the presentation. First, we'll talk about HDFC Bank. Then we'll jump to the fundamental analysis, which will include SWOT analysis of HDFC Bank, Porter's five forces. Then we'll jump to the blockchain. First, we'll cover what is blockchain, blockchain development life cycle and its different phases. Then blockchain application in Indian industry, and finally, COVID-19 impact on the banking sector. So let's talk about HDFC Bank. HDFC stands for Housing Development Finance Corporation. HDFC Bank was incorporated in August 1994 in the name of HDFC Bank Limited. With its registered office in Mumbai, the bank commenced operation as a scheduled commercial bank in January 1995. The picture is shown in the PPT. HDFC was among the first financial institution in India to receive an in principle approval from Reserve Bank of India to set up a bank in private sector. This was done as a part of RBI's policy for liberalization of Indian banking industry in 1994. So let's see the line of business of HDFC Bank. First, they cater to retail banking. HDFC Bank offers a diverse range of financial products and banking services to customers through a growing branches and ATM networks and digital channels such as network banking, phone banking, and mobile banking. Next, wholesale banking. HDFC Bank offers a wide range of commercial transactional banking services to businesses and organizations of all sizes. HDFC Bank's services include working capital finance, trade services, transactional services, and cash management. And treasury. Under the treasury service, HDFC help businesses generate better returns on their funds and manage financial risk. HDFC Bank focuses on three main product areas: foreign exchange and derivatives, local currency, money market, and debt securities and equities. Now let's jump to the fundamental analysis and for SWOT analysis. SWOT stands for strength, weaknesses, opportunities, and threats. So first we'll look at strengths. HDFC Bank is second biggest private financial bank in India, having 5,103 branches and 13,160 ATMs. HDFC Bank is situated in 2,748 cities or towns in India and has an excess of 800 areas to serve clients through telephone banking. The bank ATM card is perfect with all local and worldwide Visa MasterCard, Visa Electro Mastro, and American Express. This is one purpose behind HDFC cards to be the most favored cards for shopping and online exchanges. Then, HDFC Bank has high level of customer loyalty when contrasted with other private banks. Its strengths include HDFC Bank's digital initiatives. They are very good, and HDFC was among the first bank which initiated mobile banking in the banking sector of India. HDFC has received a lot of awards and recognition. It has received Best Bank Award from various financial rating institutions like Dun and Bradstreet, Financial Express, Euromoney Award for Excellence, Finance Asia Country Award, and CNBC TV18 India Business Leader Award in in 2019 and 20. HDFC Bank is late adopter of blockchain technology as compared to its competitors. HDFC Bank has less penetration in rural regions as compared to ICICI Bank. Its immediate rival is growing in country. HDFC cannot enjoy first mover advantage in rural areas. Rural people are hardcore loyal in terms of banking services. The bank mainly focuses on very good quality customers. Opportunities. HDFC Bank has better resource quality parameters over government banks and subsequently the cooperative banks. HDFC has well recognition in abroad market, so it has open doors in abroad market. Let's see the threats. COVID-19 impact in retail and wholesale banking products has affected. I mean, HDFC got affected because of COVID-19. RBI has opened up 74% for foreign banks to put resources into the Indian market. HDFC's NPA, non-performing asset, that is NPA, expanded from 0.18% to 0.20%, in spite of the fact that it is a slight variation. The NBFC and new age banks like Digital Bank of Singapore, DBS, are expanding in India. So this was a SWOT analysis of HDFC Bank. Now let's see the porous five forces, which includes threat of new entrant, bargaining power of supplier, bargaining power of buyer, threat of substitute product. So let's focus on first, that is threat of new entrant. Barriers to an entry in banking industry no longer exist. So lots of private and foreign banks are entering in the market. Product differentiation is difficult for banks and exit is also difficult. So every bank strives to survive in a highly competitive market. Intense competition and mergers and acquisitions can be seen in the sector. Government policies are supportive to start a new bank. There are less statutory requirement needed to start a new venture. Every bank tries to achieve economies of scale through use of technology and selecting and training manpower. So according to me, threat of new entrant is very high. Then we'll go to the second part, that is bargaining power of supplier. Supplier of the banks are depositors. These are the people who have excess money and prefer regular income and safety. In banking industry, suppliers have too low bargaining power due to following reasons. Nature of supplier. Supplier of the bank are generally those people who prefer low risk and those who need regular income and safety as well. Few alternatives. Suppliers avoid risk and want regular income, so they have few alternatives available with them to invest like treasury bills, government bond. So few alternatives, yeah. Third, regulations of RBI. Banks are subject to RBI rules and regulations, so RBI takes all the decisions relating to interest rate. These all factors reduces the bargaining power of supplier. Now let's see the third one, bargaining power of buyer. Customers of the banks are those who take loans, advances, and use services of banks. Customers have high bargaining power due to following reasons. Many alternatives. Customers have very large number of alternatives. There are many banks which fight for the same pie. There are many non-financial institutions which have also jumped into the business. There are foreign banks, private banks, cooperative banks, and development banks together with the specialized financial companies that provide finance to customers. Then, low switching cost. Cost of switching from the one bank to another bank is low. Banks are also providing zero balance account and other types of facilities. They are free to select bank services. Switching costs are becoming lower with internet banking gaining the moment. Third is undifferent services or similar services. There is no much different in services provided by different banks. information about the market. Due to globalization and digitalization, customers have become advanced and sophisticated. They are aware with each market condition. So all these factors include increases the bargaining power of buyer. Let's see threat of substitute products now. Competition from non-banking financial sector is increasing rapidly. Google and software giants like Microsoft, Facebook are attempting to replace the banks as intermediaries. There are other substitutes as well for banks like mutual funds, stocks, government securities, debentures, gold, real estate, etc. So, I feel this increases the threat of substitute products. And the final force of Porter's model is rivalry among the existing players. Rivalry in banking industry is very high. There are so many private, public, cooperative, and non-financial institutions operating in the industry. There are fighting for the same customer. Due to government liberalization and globalization policy, banking sector has become open for everybody. So newer and newer private and foreign firms are opening their branches in India. So this has intensified the competition, and I feel the rivalry among the existing players is very high. So to conclude, India's increasing rank in ease of doing business make in India initiative low entry barriers, making industry attractive. At the same time, COVID-19 impact, rising issues of NPAs, regulatory issues, high exit barriers, increasing competition puts industry on back foot. So I would say that the industry is moderately attractive at current situation. Now let's jump to the technical aspect. That is, what is blockchain? So this is the diagram which will refer while understanding what is blockchain. So it is a database, a list of records or transactions like ledger that keeps growing as more and more entries are added, which is distributed. Copies of entire database are stored on multiple computers on a network, syncing within minutes or seconds. Adjustably transparent, records stored in database may be made visible to relevant stakeholders without risk of alteration. Then it is highly secure. Malicious actors like hackers can no longer just attack one computer and change any record. And it is immutable. The mathematical algorithm makes it impossible to change or delete any data once recorded and accepted in the blockchain. So this was the overview of blockchain and what is blockchain. Now let's see the six packs of blockchain. There are six main features of blockchain. Distributed database. The most fundamental difference between distributed ledger technology, that is blockchain, and the way we store data today is that distributed ledger do not have a central administrator. A distributed ledger is replicated, shared, or synchronized digital data geographically separate across multiple sites, countries, institutions. This makes information available across the network and fully transparent, autonomous way. Then, consistent driven trust. In blockchain, there is no need for middlemen that you must trust. Trust is driven by consensus algorithms such as proof of work, proof of stake, proof of authority. As a result, you don't need to worry about unreliable, inaccurate, dishonest, or overpriced intermediaries. Third is immutable transaction driven auditability. Each block in the blockchain contains timestamp or and a link to previous block. By definition, blockchains are inherently resistant to modification of the data. Once recorded, the data is any given block cannot be altered, altered without an alteration of all subsequent blocks, and a collusion of network majority creating a single source of truth, making it especially attractive to finance executives in search of auditable trials. Hashing algorithms. All records on blockchain are individually encrypted. Blockchains use cryptographic hashing codes to verify data that drives up integrity and creates strong reliance to cybersecurity concerns. Smart contracts. Several blockchains also offer smart contract functionality. These are computer protocols that facilitate, verify, and enforce the negotiation or performance of a contract, or that prevent the need of contractual clauses. This allows contracts to auto-execute based on the preset conditions or triggers, and allows for much higher level of straight-through processing. Permissionless and permissioned blockchains. Much like public and private clouds, blockchain can be private, that is permissioned, public, permissionless, or somewhere in between, that is hybrid. This favors give an enterprise the flexibility to choose solution based on their needs and preference. Permission blockchain enhance privacy and takes less computational power, so have higher throughput, but lag lag the output. Much like early days of cloud, 80% of current solutions are running on private, that is permissioned blockchains. Now let's see blockchain project development life cycle. So we have different phases. First is conceptualization. First we conceptualize the blockchain, then we create a prototype in the prototyping phase. Then we try pilot runs, parallel running processes. Then we once the pilot run is successful, we go to the product building, and finally the product moves in the production phase. So looking at the diagram from top to bottom, five phases are mentioned, and from left to right, the feasibility of the project. So in case of feasibility, the banking and financial services and industry in the insurance industry stands outmost. And if we see the phases, all the projects are somewhere in between prototyping and pilot run phases. None of the very few products have moved to the production phase. Now let's see blockchain application in Indian banking industry. So as shown in the diagram, Kotak and Yes Bank are first movers, and HDFC is late adopter maybe. Kotak in 2016-17 did introduction to the blockchain. Then in 17-18 they did the evaluation, and in 2018-19 joined Ripple for international remittance. Uh, Yes Bank followed the same path. In 2016-17, they did the introduction. Then in 17-18, they started supply chain financing using blockchain. And in 2018-19, they joined Ripple for international remittance. SBI also directly jumped to the blockchain initiatives in 2017-18 and joined Ripple for international remittances. Axis Bank also joined Ripple in 2017-18 for international remittances. And HDFC, if you go to see it, just introduced blockchain initiatives in 2018-19. So, to conclude this slide, HDFC is late adopter and Ripple is leading blockchain technology uh, developer and supplier in India. So majority of banks are associated with them. So yes. Now let's see COVID-19 impact on banking industry. Though banks are not being hit by the COVID-19 as directly as other retail institutions, they are at the forefront of public attention. Banks sits at the heart of the economy and provide funding to corporates and individuals. The stability is crucial to keep the system up and running. Tens of thousands of customers are now being placed under quarantine or lockdown. As a result, many might lose their ability to pay for credit, particularly mortgages. Also, business loans, especially to small and medium enterprises, are at risk due to forced shutdown. But entire industries such as travel industry, hospitality industry, automobile industry will be hard hit as they will have no way to make up for the lost revenues in the future. Now let's see what is getting impacted. First is credit management. The cash flow of many consumers and business will collapse as lack of demand flows through, and it will reduce the business revenues and employee layoffs will happen. These in turn will cause an increase in both commercial and retail non-performing loans as borrowers struggle to make scheduled interest and principal payments. Banks should support government actions, initiate credit modification programs, prepare for losses, and banks should extend credit periods and digitize to manage the demand. Revenue compression. In the first few weeks of pandemic, the banking industry market value fell to lower level than during the 2008-9 crisis. This is because the market has factored in short-term revenue compression from multiple sources, including a drop in payment revenue, a decline in trade finance, and cross-border payments. Next is customer service. A short-term impact of this pandemic will be rapid changes in customer servicing preferences. While many bank branches will stay open as essential services, customers are increasingly looking to run their financial life through apps and online banking. Banks should educate and train their customers to operate online and how to make use of other many services which are offered online. Minimize the physical infection risk. That is, they should ask their customers to stay home and do their financial or transactions. Banks should give personalized advice to the customers in these conditions. Next is changes in operational model. The cumulative impact of the 3 points above will lead to a misalignment of short-term revenue and expenses in the banking sector. Sector expects a range of impact from 50 to 100% drop in profit before tax, as demands for the next 4 to 6 months will be different from what was predicted 6 weeks ago or maybe the months ago. And the last part, digital initiatives, Blank should definitely try to implement blockchain technology as early as possible. They can use smart contracts and they can perform contactless contracts. Then they can also set up their customer support centers on the cloud as mentioned. Amazon, as mentioned by Jeff Bezos, Amazon is very much capable of setting up their any institute's customer support center over the cloud, and the setup time is only 45 minutes. And if you allow them to to do the setups and initiations for the automated replies, it will only takes more 18 hours. So in a day, organization can have their own cloud based customer support centers. So yeah, banks should definitely work on digital initiatives right now. We should take this COVID-19 impact very much positively, as Bill Gates said that during the World War II, we came up with or we saw many new inventions and many new technologies coming up like radar technology, then cryptographic encryption technology. So yeah, we should take it in a positive way, and we should focus that how we can improve during these times and how banks can improve during these times. So that's the so this brings the end of the session, and I would like to thank you all for watching the video. My special thanks to Miss Professor Priyanka Dhingra and Mr. Ankur Pandey for guiding me. And my personal request to all: please ignore the crows and birds in the background. Have a nice day, guys. Bye.